Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is Monday morning, April 10th, and this is The Talking Point. Thanks so much for joining me. I'm doing this call well before the market opens. It looks as if we're going to have a weak opening, but there's so much going on this week that it will move the market in one direction, certainly, or another. Let's go over some of the important events from last week, however. One, we saw that the job openings actually eased a bit, meaning fewer job openings. Now, keep in mind, we still have thousands and thousands of job openings, but it is easing. And the reason we mention this is that the Fed has always maintained that the best way to get to lower wages, because that's what they're looking for, wages remain sticky. Although they're coming down a bit, they're still quite high. But when you have fewer job openings and those who are looking for jobs then don't have as many opportunities to go around and look for higher wages and higher wages. It kind of makes sense, correct? And that's important because the more that they can get wages down and just sort of level off, and the payroll report on Friday, it actually showed that it was elevated still, but not as much as it's been in the past. Because the key here is very simple. The more I have to pay my workers, it's an input cost. You've heard me say this. The more I'm going to try to get it in higher prices. That's what they do, whether it is a business to business, whether it is business to retail and retail to retail. You'll try to get it back by raising the prices. Now, so that was good news. Fewer job openings. We also saw that the initial unemployment claims climbed. That's telling us, obviously, that more people who lost their jobs are going and they're not finding other jobs that quickly. Because that's typically what was happening. Oh, I lose my job. That's fine. I could probably get 3 other offers within 2 weeks. If that slows down also, what that does is for the labor market, it means that the wages also can level off. That's what the Fed is concerned about. Chairman Powell has mentioned it many times, that you can't have these wages going up, up, and up. He's been asked by many, economists, well, isn't that a good thing that folks are getting higher wages? His point has been this: not if it means that you have to pay higher interest rate costs, right? Because you're using your credit card more. You're paying more for goods and services. You're paying more for everything. No, it isn't. We've got to get those wages down. And he has always added this: you can't have a healthy labor market without price stability. You can't have a healthy economy without price stability. So all of that is part of that theme. You can't have wages galloping higher, because all it does is it leads to higher prices. And so that was that. Now we get to the labor report itself on Friday. It was very interesting. It showed, yes, we're adding jobs. There's no doubt about that. But it was less than consensus estimates. By the way, the ADP report that came out on Wednesday also showed that was less than consensus estimates. Remember, the ADP report is just about the private sector, and it is based on data. That's why many economists look to that to get a clearer picture of the payroll landscape. Whereas the government report on Friday is very much based on surveys. So in any case, both of them came in lower than consensus estimates. Now, again, the labor market did not collapse. It's just that when I take the number of job openings, I also then take the initial unemployment claims climbing, and I take a look at the payroll report less than consensus estimates, I'm looking at a slowdown. If it continues, right? One data release does not make a trend. But nonetheless, what you also have in the market is a shift, whereas it was bad news became good news, and now maybe it is bad news is actually just that, bad news. We will see this week, because this week there is an abundance of economic data that is very important. We are going to have the National Federation of Independent Business optimism survey. That'll come out tomorrow. I pay very close attention to it. Why? They are the biggest employers in this country. They are the backbone of the employment landscape, and we'll see what they have to say. Then also we will have a parade of Fed speakers. Now, when I say parade of Fed speakers, I don't mean that as a pejorative. I just mean that there is going to be Fed speaking every single day. And, the market has to absorb what they have to say as well. The other thing that we're going to have is, this is the big one, on Wednesday, we will have the Consumer Price Index. And obviously, what we want to see is that inflation is coming down, that it's coming down on all levels. And, you say that the Fed only looks at core inflation. True, but everybody else who lives in the world looks at headline. That's food and it is energy. And this is going to be very important because the market is trying to assess when the Fed is going to be finished. And the Fed is trying to assess that as well, by the way, based on many of the reports we've seen regarding the last Fed meeting where we did get 25 basis points. And then the next day, we're going to have the Producer Price Index, and that obviously is very important too. It gives us the cost of production, and obviously you want to see that coming down, not collapsing, but coming down. And then we're going to have industrial production, and we're going to have retail sales and consumer sentiment. Now, I want to add here that we have seen over the last couple of weeks, a couple of economic data releases that show that now we're starting to see that on durable goods, where you have core durable goods, which actually is a reflection of what companies are spending. They're spending less. This is another indication. Again, it's just starting, but we want to see if that's a trend. So we're keeping our eyes open for that when we get that next durable goods report. Industrial production, we know, is down. I also want to mention that we also saw the Institute for Supply Management. This is the purchasing managers' reports. And I do want to say they have a positive correlation with the S&P 500. When you start to see a contractions, 50 is the level where you either go up, and that is expansion, down below 50, it is contraction. Manufacturing has been in contraction. This is important, but remember, manufacturing is not only, but is about 8% of our economy. That said, we also had the consumer part of the Institute for Supply Management last week. And this is extremely important. It came down more than consensus estimates. It had been in the high 50s, and now it is just above that all-important 50 level, where you have expansion and contraction. This is important. That is the majority of our economy. And needless to say, it is something that also worried the market. Again, not in contraction for the service sector part of the economy, but just above that important level of 50. We'll keep our eyes on that. Now, this week, we also open the earnings season, quote unquote, officially, and we will hear from the banks. Now, this is also extremely important because we know that one of the other elements that is of concern in the market is, what about lending? Are you able to go out and get a loan for a vehicle? Can a small business owner go out and take out a loan in case that business owner needs it for buying more equipment, for example? This is the problem. The concern is that banks are going to be much more careful. They are going to up the standard in order to get a loan, but it will also be more costly. Now, ironically, on March 22nd, when the Fed had its meeting, if you take a look at some of the data releases, it happened to be a day where loan growth was actually very, very strong. And then after that meeting, as we've just seen from the data that's just been released, loan growth has shrunk. Now, granted, it is a knee-jerk reaction to the banking situation that we had, the banking crisis that we had, and we don't know if that's going to be the case going into April. But nonetheless, we have seen at the very end of March, when all of this started with the banks, that you are seeing lending down, and down markedly, by the way. We need to see lending remain healthy. Obviously, that helps underpin our economy. So this is also something that we are going to be paying very close attention to. And because the banks are actually leading the earnings season and it'll begin this week, I'm sure that they are going to touch upon what they're seeing in terms of guidance, in terms of lending, what their plans are from the retail side, from the business side, and so on. This is going to be a very important earnings season. We are also looking to pay attention to what are they seeing in terms of spending for on the credit cards for their low wage earners, their high wage earners, their mid wage earners. The banks have access to all of that information, and that is going to be extremely important. Guidance is crucial. I know we say that almost every earnings season, but you can understand why now guidance is important. The other reason all of this fits in is that what is the Fed planning for its next meeting, right, in May? Are they planning to perhaps pause? Are they planning to come in with another 25 basis points? Right now, the expectations are in the futures market is leaning towards another 25 basis points. And then if we pull back, the rationale for that is that, well, as long as nothing is collapsing, as long as the labor market still remains solid, maybe now is the time to get that extra 25 basis points in. But a lot can happen. Also this week, actually, we'll get the minutes coming out from the meeting. But you should take a look at, if you read the Wall Street Journal, they had a very interesting article about the discussion that led to the 25 basis points and the kind of the back and forth on whether or not it was a good idea or not a good idea in the midst of that banking crisis. So there is an awful lot for the market to absorb. I'm also paying attention to leadership in the equity market. We saw the end last week. It was utilities, it was consumer staples. Yes, it was all the things that you associate with a market that's becoming more cautious. However, we could go through the week, the data release is coming out, and we could see a shift and we go back towards that cyclical orientation that had led this market higher for so many weeks. And much is going to depend on that CPI report, because when it comes out, if we see inflation coming down in a measured way, the market could say, okay, maybe the Fed says we don't really need to go with another rate hike. And I end with this. Remember what Chairman Powell said at the meeting. He said, if we see stress in the loan market and we don't see much lending out, that actually is a substitute for tightening, right? It's a substitute for tightening. When all is said and done, when central banks raise rates, they want to see a slowdown in the economy. That's what they're looking for. They want to slow down in demand. And it is very much through those higher rates that you start to see a tightening in financial conditions and lending standards. So this is going to be interesting as we get through the week and we hear from the banks. It's going to be extremely important and an important week for the market. Pay attention, please, to the responses in the Treasury market and especially the 2-year Treasury yield. That was very closely associated with Federal Reserve policy. So altogether, busy week, an important week, and we will have a lot of information when we finish the week. Have a good week. Thank you so much for listening.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are or generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.